The infinite banking concept is a process of taking back the banking function in your life. We are making a spread just like a bank. When you own the bank, you make the rules. We're making money twice on the same dollar. We're not making money once like you're used to. You're making money twice. Why do you want to be the bank? Why do you want to be in control of your money? Why would I ever consider changing what I'm doing? Because what I'm doing feels like it's working. Well, now you know that by changing just one thing and adding one step, you can improve that process.
Hey, what's up, everyone? Welcome to Wealth Webinar Wednesday and a very special 4-week edition of March Money Madness. I'm Stephen Nagy. I'll be co-hosting with your host, Chris Naugle, over the next 4 weeks. And we have an awesome schedule planned for you. We have incredible strategies that could not be more timely for what's going on in the markets right now. And really looking forward to these 4 weeks coming up every single Wednesday, 1 p.m. Eastern. Be here or be square. So with that being said, in all seriousness though, those of you that have been around our campfire, welcome back. Those of you that are new to our campfire, we do several webinars and live streams every single week, all financial education, all different, all live, all interactive. We always have a great time with everything. So feel free to join us for all of our shows. And starting right now, over the next 4 weeks for this March Money Madness, what we decided to do was bring you what we typically teach in our 3-day Money School Essentials Foundational Training course. Instead of doing it over 3 days, we decided to kind of consolidate it and put it into this 4-week series that we have. And since I'm personally a big sports fan, I love sports, we just are playing along with this theme of March Madness. Of course, NCAA basketball tournament, just turning into a little bit of fun with money. So, Chris, thanks for putting me on the spot there. I hope that was a good introduction for everyone.
That was perfect, man. Perfect. Gave me a chance to hit up some people over here in the chat. And folks, listen, one of the things we love to do with these trainings is answer your questions. We're going to give you some real value today. Today is going to be all about the fundamentals of money, the truth about money, and how to take back control of your money. So that's what we're going to get into today. But I love making sure that we tackle every one of your questions, everything that you have to say. So as you can see, these chats in our webinars that we do every week just blow up. We get hundreds of chats, which gets hard. We're going to do our best to answer them. But if you really have something you want us to address, we can address it individually. So if it's private, just write private. Or if it's something you want me to address the whole audience, put it over in the Q&A. It's right down below in the Q&A. So I want all of you to first and foremost think about everything you know about money up to this point. Just let that sink in. What have you been taught? How have you been taught money works? Now, all of your stories are going to be different. Mine, I was talking about it in that video. My mom taught me how to save. She taught me how to save by taking spare change from when she went to the grocery store or the store and putting it in a big glass jar. That was my first experience with saving. Now, as time went by, that worked, but obviously I developed my own ways of saving, or my own ways of not saving for that matter. I would save money up for things. How many of you that are on here save money for a specific thing you're looking to buy? I don't care if it's a car, a piece of real estate. I don't care if it's a lawnmower. How many of you do that? Put I in the chat, because that is a fundamental thing. And that's really what we're doing. Now, that's kind of interesting. I got a lot of sometimes on there. Okay, sometimes. But most of you, you can think of something throughout your life that you have taken money and you've put it into a separate account somewhere. Maybe it's under your mattress, a little box at home. Maybe I use a little Red Bull can that I shove some extra money in. I still do this today because it's just fun, isn't it? You forget about it, and then you're kind of going through your old stuff and you're like, oh my God, there's a couple $100 in there. That is just saving, but we like to save for a purpose. But what has happened is, as time has gone on, our savings weren't enough to accomplish the lifestyle that we wanted. So what did we learn about? I'll never forget when I was 16 years old, I took out my very first loan from Cornerstone Federal Credit Union. And I thought, okay, and this was for my store, or not my store, my clothing line, Fat Clothing Company. They gave me a $500 loan that my mom signed on. So she had to basically come on as a secondary signer on that loan. How many of you can relate to that? Then after that, I got a credit card. I had a Visa from Cornerstone Federal Credit Union for the longest time with a credit limit. How many of you can guess how much my credit limit was on that first credit card? $500, right? That was it. All of your stories start about the same, but then what happened? Life has been changing. I've been on this planet for 47 years, okay? So a lot has changed in those 47 years. Back in the day, we paid for everything with cash. Paid for gas, paid for dinners, everything was paid for in cash. Credit cards were only used for like an emergency. Boy, is it a little different now, huh? How many of you legitimately pay for things with cash today? Listen, if you're anything like me, I keep very little money in my wallet. Like last night, I took Larissa out for dinner and we used a gift card, but she wanted money for a tip. And I went into my wallet. I'm like, whoa, I didn't have much. I have 50 bucks. And then I gave it to her for the tip. But like, I was thinking to myself, I'm like, I didn't even know how much money I had in my wallet. I don't use cash anymore. Everything we do is a swipe, right? We've kind of evolved into that, but that is not a good thing for most people, because as we've evolved into that, we have spent more than we make in some cases. We stack debt. Oh, I want a new car. Great. It's only $500 a month. Cool. Sign me up. Wife needs a new car. Okay. Oh, that's only $400 a month. Great. All right. College education. Need that too. Okay. That's only $800 a month. So you start stacking all these debts, and then the credit card's the easy thing because we're just used to using it. We always have the best intention with our credit cards of spending money on the card and doing what at the end of the month? Paying it off and going back to zero. Because we know if you pay the credit card off by a specific date, you pay no interest. That's like free freaking money. Oh, and then you get the points and you get the free airlines and all the vacations and all that stuff. But according to statistics, that's kind of failed us. That has failed us because if you look right now, the consumer debt, the credit card debt in this country alone is over $1 trillion. We live in a debt-induced bubble, and we have no one to blame but the system and ourselves. So what my goal is today is to really talk about where the system will always let you down, where banks will always let you down. But that's okay, because I'm going to show you a path used by the wealthiest families throughout history, a path that is not difficult because it's doing the exact same thing you're doing today, except for you change one thing, where your money goes first. And I'll get into that in a second. And then you add one step, which is not a step that is any different than what you are already doing. It's just a different flow of where your money goes. In this program, all the checks you write go back to you. Wouldn't that be cool? Just for a second, okay? I just want you to all think about all the checks you write for all the debts you have. How much is it? You got the mortgage, got the credit cards, student loans, got that loan on that thingamajigger I don't even have anymore, got these credit card debts, and these you just add them all up. What is your number? $1,500? $2,000? $3,000? $5,000? Whatever your number is, you don't have to put it over there. That is money that is leaving your family forever. That is money that will never work for you again. It will never earn for you. It will never earn compounding interest. That money is gone. And that money that leaves your family requires you to be plugged into a system that requires you to trade hours for dollars. When you want to get ahead or when things get rough, what do? You put more hours in, overtime, double time, weekends, all of those extras. That time takes you away from the things in life you really want to do, which is spend time with loved ones, play with your kids, go on a vacation with the ones you love. Think about that. Time is the biggest thing that is being robbed for us. Now, let me give you two absolute facts. There is no one who has ever saved their way to wealth, period. No one has ever saved their way to wealth. And no one has ever worked so much in their life that they were happy about it. Those are two facts. Because if you go to people that are on their deathbed and you ask them what they would have changed, they would have spent more time with their loved ones, with their family. So essentially, with today's topic, I'm going to walk you through the fundamentals, the basics, okay? But everything I'm going to show you is for one purpose. And if this is not a purpose that suits your needs and goals, then today is not a good day for you to be on March Money Madness. Now, here's what you're going to learn. You are going to learn how to buy back time. You are going to learn how to create more time without losing anything. You're going to learn how to make your money work for you 24 hours a day, 7 days a week, therefore, so you do not have to work more hours. And eventually, you'll be able to work less hours because your dollars are working harder and harder, and your dollars are multiplying. We call that compounding. And it doesn't matter whether or not you use those dollars, they will always continue to compound. These are the fundamentals. Just like Michael Jordan, the greatest basketball player of all time, got to mention that because this is March Money Madness, not March Madness. Michael Jordan had a very unique routine, and I read a book with one of his trainers, and it talked about specifically Michael Jordan's work ethic. He was one of the hardest working basketball players. He didn't get to where he was, being the best basketball player of all time, by just simply natural talent. He did have natural talent, but he put the work in. But here's how it always started. Every day, even when he was the greatest basketball player of all time, he was bar none the best, highest paid everything. When that man, Michael Jordan, stepped on the court for practice, he always went back to the basics. Footwork, dribbling, basic shots. Michael Jordan could have rolled out of bed and dunked the ball over any one of our heads. But he went back to the basics, which is why today, the first day of March Money Madness, we need to go back to the basics. I'm going to start with a story. I don't know how much you know about me. You can research it, but I've gotten to a point now where we do pretty well. I run 16 different companies, lots of different things. Financially, I don't look at money the same way I did 10 years ago. I don't go to work or do the things I do because I need to make more money. I do it because I have a goal. But there was a day where I did everything for that money because I needed it. That's what I needed to live. And it doesn't matter where in that spectrum any of you are, it doesn't change your next steps. I think it was a year ago. I had this, there's this bank that I used to bank with. Okay, it used to be called First Niagara Bank. Okay, and then it was bought by KeyBank. Many of you know KeyBank. And with KeyBank for literally, it had to have been 20 years. I can't think of it. It might even been longer. My mom and I, with my mom's house, some of you saw the video earlier, that little 700 square foot house. My mom still lives there. It's a little more than 700 square foot because she put a little room on the back, but she still lives in that house. We had a home equity line of credit on that house for 20 plus years. We would use that. I remember my mom put her house on the line so that I could get a loan for my store. Then that turned into the HELOC, which I would lend out, and I would pay, my mom would get the interest, and that was how she paid for her car. Because I'll never forget, how many of you have a parent that always complains about money? All right? I'm the only one, right? So I remember my mom's car broke down. She needed to get a new one. I said, Mom, just buy a car. And she's like, I can't afford it. I said, okay, you can. And she said, no, I really can't afford that payment. It's so expensive. When did cars get so expensive? Oh my God, I remember when cars were $8,000. Anyway, you know that story, how parents are. And I said, Mom, how about this? You know the house you live in, let's use that home equity line of credit. We'll lend money out, and the amount we lent out was 30 grand. Her line was only 70 grand. We lent out 30 grand. We took the interest. That paid for her car. So I taught my mom this. This is in the early days when I was teaching her how to use money smarter. But nonetheless, last year, I got a letter from that bank. And that letter said, your home equity line of credit is coming to maturity, and you'll have to either cancel it and repay it, or you're going to have to reapply. So I didn't have much money on the HELOC, so I reapplied. Now, this is just last year. And just so you all know, last year, my tax bill alone was just about $1 million. Okay, so I think we can rule out the fact that I didn't have the income to support a loan. My credit score last year was probably somewhere in the mid 700s. Okay, I'm not bragging, I'm just giving you the facts. So, you know, had income, had businesses, I have a W-2 paycheck that I get. My credit score is in the mid 7s, not perfect, but not bad. And I applied for a reinstatement of this home equity line of credit to this KeyBank. How many of you would think that there would be no issue in getting that home equity line of credit reinstated? That should be a no-brainer, should be an easy one, right? If any of you think, no, I think you wouldn't have got it. Oh, some of you are probably asking, well, how much was the home equity line of credit for? $75,000. Did you know that that bank turned me down? That bank said no. I fought. I gave them what they wanted. Now, here's the thing. I had a good CPA, so obviously we write a lot of things off. So we didn't have a ton of income personally. I personally didn't make a lot. My companies did, but I personally didn't make much because I had foundations and all sorts of stuff. They literally denied me that loan. I start with that story because if we stay plugged into the system, and some of you will decide to stay plugged in, and some of you will decide that this method of being your own bank is the better method. If some of you decide to stay plugged in, there will always be a day where the bank tells you no. And that day, in most cases, will be that exact moment when you need it most. If that's okay by you, carry on. If that's a problem for you, you're going to love what we're going to talk about. Now, I've got a bunch of slides and I want to share these, okay, because it's going to tell a story. And I think this is very important. So let me start with this one. And also, I'd like to give a big shout out to everybody, including all of our new folks, over 200 people. Thank you, thank you, thank you. March Money Madness in effect. Look at this slide right here. And I want to go through a series of questions and I want all of you to answer in the comments here. Stephen, if you can try to stay up on the comments, that'd be awesome. So here we go. See that picture far top left? That's a restaurant. I want all of you to imagine that you own that restaurant. It was your dream. It was your goal to own a restaurant. So you put the blood, sweat, and tears in. Maybe mom co-signed a loan. Maybe you just scrimped and saved and opened it. That's your restaurant. Now, let me ask you one question. Are you proud of your restaurant? You are, right? Do you invite your friends to come meet you for dinner at your restaurant? Or do you go to your friends and invite them to go to Applebee's across the street? You invite them to your restaurant, right? When people come in town for business meetings, do you set up a reservation at another restaurant or do you bring them to your restaurant? Every one of you said your restaurant, right? You bring your friends and family to your restaurant. You're proud of your restaurant. You bring business colleagues for business meetings to your restaurant because it's yours. You worked very hard to accomplish that dream. Now I'm going to go a little faster. It's going to be the same thing for each one of these. You open a salon. Your dream was always you wanted to open your own salon. You no longer wanted to work for somebody, so that's your salon. Now let me ask you a question. When you need a haircut, your nails done, your toenails done, whatever you get done, where do you go? Do you go to your salon or do you go down the street to the competitor? Silly question. Of course you go to your salon. You would, of course, never ever want your customers to see you not getting your hair done, your nails, whatever services you offer done at your restaurant. And can you just imagine that one day that you decided to go down to the other place and you were going there because you thought the service was going to be better. And then all of a sudden, one of your customers happens to be sitting next to you and you're just, what are you going to say to them? Oh, yeah, I'm just checking out the competition. I just want to see what they do here so I can make things. Is that really going to be what your client, your customer is going to perceive as good? They're probably thinking, wait a second, if you're going to the competitor, then I'm going to start going to the competitor. Okay, bottom left. A lot of you go to a gym, and I do as well. And I will tell you, the gym I go to, the owner, Justin, is there every morning. And I get to the gym around 5:30 to 6 a.m. He is there every morning. I've gone there on Saturdays, and guess who's at the gym? Justin. He worked really hard. The name of the gym is Jada Blitz. He worked really hard, him and his wife, to open that. That's their pride. He loves it. It's his dream. And therefore, he invites people. He doesn't go across the street to another Anytime Fitness to work out. He's always in his gym working out. He's always training people. He wants his customers to see him there because he's proud of it. Now I'm going to get to the point. Far right. That is a bank. You worked very hard and you opened your own traditional bank. There it is. The sign on the outside of that building is your name, and then underneath it, it says bank. Miller's Bank, Savini Bank, Hewlett Bank, McKinnon Bank. It's your bank. That is your pride and joy. Now, we're going to go through a series of questions. Pay attention. You own the bank. Do you make deposits for your savings into your bank? Or do you go across the street to Bank of America? Your bank, right? Every one of you, all 212 of you, you better have put down you make deposits into your bank. Now let's go further. When you need a loan for a car, you need a mortgage for your house, you need money for something. Do you come into your bank and borrow money from your bank? Or, again, do you go across the street to Bank of America and take a loan from them? Stupid question. Of course, you borrow money from your bank. Now, when you borrow money from your bank, This is critical, and this is going to set the pace for everything else we're going to cover. When you borrow money from your bank, do you repay the loans with interest back to your bank? This is important. Stephen, what are they saying? Because I can't even keep up. There's 158 new messages. I'm literally falling behind here.
It's rolling. Yeah, we got yes, 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 yes.
But hold on, I see a no.
Let me see.
Okay. MESERASTUS. I'll definitely say that not wrong, said no. Okay. Anyone else say no? Let me ask the question another way. If you owned a bank, you made deposits in your bank, and you took a loan from your bank, how many of you would not pay your bank back with interest? That's all I need to know. Just put I if you would not pay your bank back with interest. Maybe they have not until now. Okay, so Mark, so I'm going to pick on a couple of folks here. Okay, so there's two. We got Mark and Rosalina. There's a bunch more coming in. But I got to ask you, if you borrowed money from your bank, why would you not pay your bank back? That's the first question I'd ask. Why would you not pay your bank back? And why would you not pay your bank back with interest? This is a very common thing. I'm not picking anybody. I'm not trying to make anyone feel bad for saying no, but I want to know why you wouldn't. It's your bank. Your name's on the outside. And every payment you make back to your bank with interest is more money your bank has to lend to next day. That's your bank's operations. Because remember how a bank works. And let me just pause, and I'm actually going to stop sharing the screen. I'm going to come back to this in just a second, but I want to show you something here. All right. So some of you said you wouldn't pay the bank back, but here's your bank. This is your bank that we just talked about. You make deposits into your bank. Nobody said that they wouldn't do that. Then when you need a loan, you take a loan from your bank. Okay, and you can decide. Remember, it's your bank, so you can pick and choose what percentage interest rate you want to pay. But all I need you to know, and this is you over here, okay? And you own the bank. I want that to be very clear. So you took a loan, okay, here, and then, I don't know, whatever. Let's just say the payment could be anything you want. You can do any term, any interest rate, anything you want, but this goes back into the bank. If you owned this bank, wouldn't that mean your bank now has $200 extra every single month because that's your loan repayment? And that means now you could lend this $200 out to other people. And even you could even charge, let's say you charged yourself $3, you could charge them $8. Because how does a bank make money? First off, people deposit money in a bank for convenience, for guarantees, but they also deposit money in the bank for an interest rate, especially savings accounts. So they put money in the bank for an interest rate. Now, let's just hypothetically say the bank, your bank, is paying 3% interest. Now, you would be a really popular bank. I want to be clear with that. If you and your bank paid your depositors 3%, you'd get a lot of deposits in right now because people would be really happy with you. But now, when those deposits were getting 3%, if your client came in or your customer came into the bank, would you lend them money at a lower rate than the 3% you're paying them? You couldn't. You'd go out of business. So what would you do? Well, you would figure out a spread that you and your bank want to charge, and you would charge whatever interest rate based on a couple factors, risk, underwriting, and just some of those factors. There's a lot of things that would go into that, and you would decide how much to charge. So let's just say somebody was getting 3% on their money in the bank. They took a loan out from you, and you charged 8. How much is your bank making? Well, it's making 8 minus 3. That is the spread. You understand that. So now, if you took the loan from your bank, why would you pay your bank back any less than what you're earning? Because if you paid any less, if you didn't pay, like some people said, no, I wouldn't pay. You just took the loan and you decided because you own the bank, you're not going to make a payment back to your bank. But when you made deposits, were you not taking any interest from your bank? So you're making deposits into your bank. You pay everybody else 3%. So is it okay to say that you're just foregoing any interest that your bank would pay normal customers, that 3%, because you own the bank, so you feel you should get paid nothing in interest or less than what your customers earn? There's not one of you on here that would say, no, I'm not going to take interest from my bank. If I pay everybody else 3%, I'm going to pay myself 3%. That's only fair, right? So if that's fair, why would it be fair if you took a loan from your bank that you would not pay your bank back with interest? And that interest would have to be more than your bank is paying you. So if your bank is paying you 3, it has to be at least 4 or 3.5. You got to make money, but it wouldn't matter because you own the bank. So therefore, the $200 that you're repaying, which includes, I don't know, let's just go low, let's go 3.5%. That money goes back into the bank and can be used by your bank to lend out to somebody for 8. Why would you not want to do that? There is absolutely no reason anyone should ever think any different than that. It's just basic mathematics. It is pure logic. And I want to be clear, and some of you aren't going to like this, but I'm just a straight shooter and I'm very transparent. And I say things not because I think it's going to appease you, but because you need to hear it. If any of you still would say, no, I wouldn't pay my bank back, I'm going to tell you that today's webinar is not for you. I and my team cannot help you. I'm sorry. Take that for what it's worth. If you still felt like you wouldn't repay your bank, find something else to do today. And I'll watch the numbers and we'll lose some people here, but that's the truth. I can't help you. Nobody can help you because you're just not an honest banker. You don't value how this works. And because of that, I don't know how anything I could teach you would ever work. You see, we figured something out a long time ago, and I figured this out, and I taught my entire team this. We first must understand who our clients are not so that we can understand who our clients are. Does that make sense? A lot of people go out and they start businesses and everybody's their client, or they figure out who is our client, who is our demographic, which is important, but isn't it more important to figure out who is not your client? Because then when you get somebody you're talking to, you very quickly can identify this person is not a client. Therefore, you don't waste their time and you don't waste your time. What I just explained here is how banking works. Now, it doesn't matter if you own the bank or it's somebody else's bank. There's not a bank in the world that pays more in interest than or pays you interest and charges you less than what they pay you. Not a bank in the world. They'd all be out of business and we'd have much bigger problems. We already got enough banking problems with, some of the banks. Deutsche Bank, is not doing so well right now. So anyway, I must first start with that because that is the fundamental basics. And what we're going to teach everybody today is we're going to go through the basics of banking, which we started with. That is the basics of banking, but there's a lot more to it that we're going to hit. And everything that I'm going to teach you is going to teach you how to build wealth, okay, instead of just building crumbs. When you plug into the normal banking system, the bank's always going to pay you interest, or maybe not, but they're always going to charge you more. So you're always losing because you're not in control of your money. Now let's talk about control for just a second, because this is a fundamental as well. All of you work really hard for your money. You go to work, side hustle, maybe you have your own business, whatever. You do something, but you work hard at it. I have no doubt all 220 of you work very hard for your money. But what have we been taught? We've been taught to take this money and do exactly what all of us do and put it into the bank. You gave up control of that money the second you deposit it in the bank. Real quick, asking everybody on here, when you put money into the bank, do you think you're in control of that money? Does anyone think you're in control? Write control in the chat. Who thinks you're in control of your money when you put it in the bank? Anybody that does think they're in control? There's got to be one. All right, I'm going to use Rosalina because it was a question mark. So I'm just going to say that. So, and this is not, these aren't trick questions and I'm not going to pick at anybody. Okay. But if you were in control of your money, here's what would happen. If you controlled the money in your bank account, every time that bank was going to lend your money out, which is indeed exactly what the bank does with your money. They take your money, you make a deposit. They don't put your money in the vault. They take your money and they lend it out in those little cubicles. So you just left the bank. You deposited $10,000 in the bank. You were very proud of that. The bank's paying you 3% on that money. You're very happy you're getting 3%. You found yourself a good bank. You're almost in your car. Your phone rings. You answered. It's the bank. Oh, maybe I forgot my wallet. Maybe I forgot my license. Hi. Oh, yeah. How are you? Good, good. Yeah. Okay. You want to lend my money out? Okay. What's the interest rate? Who's this person that we're lending this 10 grand to? They got good credit? Will they personally guarantee it? Do you think there'd be a good risk? Do you think they'll ever default on the loan? Do you get those phone calls? Does the bank call you every time they're going to lend your money out? Absolutely not. You'll never get a call from the bank unless your account overdrafts, you're late on a payment, or it's never good news. They don't call you asking you whether or not they can do anything with your money because in the contract, that agreement, you gave up control of that money. And when you gave up control, that money now goes to work for the bank. It no longer works for you. If you think this right here, the interest the bank pays you, 3, 4, maybe some of you are getting 5% in the bank, which will change shortly, mark my words. Jerome Powell and the Fed will make sure they drop rates, and that will make sure that you get less money on your bank account. But nonetheless, You're getting interest on that. Is that enough? Does that cover inflation? Does that interest really, really help you? No. But the bank lends it out at 8% or whatever they lend. Banks make 400 to 1,300% more than you do on the money you leave there. And that is not me speculating. That is according to BauerFinancial.com. You can look it up too. That's how much banks make. What business do you now want to be in? If you understood the rules of engagement and you could make 400 to 1,300% more than your clients do, what business do you want to be in? The banking business. I'm going to share my screen one more time. I got a really cool slide that I just found, and I think this is fantastic. I never saw this before, and here it is. If you want to steal money, he didn't have good English, don't rob a bank, open one. Has anyone ever seen that? I just thought it was pretty funny, okay? Open one. Anyway, I don't know. Some of you probably didn't get the humor in that like I did, but I thought it was pretty funny because that is somebody that barely can spell that literally is saying that. Now, I want to go through one more thing, and I'm going to do it with a slide as well. And I want to show all of you how a bank works, because if you're going to be a bank, you must understand how a bank works. And some of you have seen this, some of you have not, but it doesn't matter. This is a great exercise, and I will do it very quickly. So when you go to a bank, you deposit money in that bank, which is shown by that, 4%. Okay, we're going to give you 4% now. And then the bank, I've already established what they do. They lend that money out. And they lend it to somebody on a collateralized asset, like a mortgage. Banks are usually in first or second position, almost always first on a mortgage. And they charge more than what they pay you, just represented there. If they did that, then when the seller gets the money for the house, we have all been trained the same thing. We have been trained to put the money back in the bank. It's really the only option outside of under your mattress. So the money goes back into the bank. The bank doesn't put it in the vault. The bank lends that money out because the bank is making this money, your 100,000, work for them. But they're making your money work for them really hard. So when they lend it out once, they lend it out again and again and again, and they keep doing this. But here on a car, they charge 8% on a loan. Car dealer gets the money, does what everybody else does, puts it in the bank. Bank lends it back out on a home remodel loan. Now remember, a home remodel loan, like a HELOC, is a second position, which carries more risk than a first position mortgage, more risk than more risk than a car loan, because a car is on wheels. This is a second position. So they're behind whoever's in first. I always refer back to Ricky Bobby and what he said. You know, he said, or his dad said to him, he said, son, if you're not first, you're last. So anyway, second position, more risk, which means more interest. So they charge 9% on that one. Contractor gets the money, puts it back in the bank. They lend it back out in an unsecured debt consolidation loan to somebody that definitely qualifies, but they charge 12%. More risk, more return. Credit cards get the money, put the money back. Now let's just go through and talk about how much you made. You made 4. How much did the bank make? 7. So the bank made a spread of 3. The bank made 4. And then in the car loan, they charged 8. So they made a spread of 4. Bank made 4, or you made 4. Bank made 9. So they made 5%. All I'm doing is doing 4 what you're making minus what the bank is charging on the loan. 12 minus 4 is 8. If we add all those up, the bank made 20. You made 4. How much more did the bank make than you in a percentage? Here's what people always do. They subtract the 20 minus the 4, which is not right, because remember, I already netted the 4 out because the spread had to discount. The spread had to take away the 4% that they're paying you. That's what a spread is. It's the net. Okay, so they made 20, you made 4. So really the mathematics here would be take the 4%, divide it into the 20, and what do you have? 5 times more, 500%. And that is exactly how banks operate. So once you understand how a bank works, what we're going to do is we're going to reverse engineer how you're going to create your own banking system. The very first thing we need to do, let me clear this screen a little bit, and we're just going to use all the same things here. Okay, I'm just going to kind of keep this super simple. Now what we're going to do is you want to unplug. You want to be in control of your money. Okay, here we go. We're going to put loan. We're going to put a percentage rate. It's going to be you, but we're going to call this something. Over here, we're going to do all the same things that the bank does, because in order to be the bank, you must think as if you are the bank. So remember earlier, in order for you to be the bank, so we're going to write be your own banker, okay? To be a bank, What you must do is change one thing, and that is where your money goes. Let's go over the rules of engagement first. We're going to put the money into a different account, okay? And I'm going to tell you in 1 second what this is. Most of you already know. But let's just go over the old way of doing this. This is a traditional bank account. Real quick, I'm going to ask everybody, what interest rate are you getting on your bank account? Is anyone getting more than 4? Anyone getting 5? Do I got a 5? Anyone getting 5? 5, 5? Anyone going 5, 5, 5? How about 4? 4? Anyone getting 4? Anyone getting 4? 4, 4, 4, 4? Anyone getting 4? 4. There we go. Shane's getting 4. All right, so you're getting 4% on the bank. Shane, on that really good bank. Oh, wait, hold on. Soto is getting 5. Got to go with the higher. Soto is getting 5%. So Soto, let me ask you a question. We got to play along here. And Liz just said, I'm unsure. I don't even know. I think I'm getting nothing. Soto, you're getting 5%. Can that 5% go up or down depending on the Fed's actions? I'll give you the answer. Yes. It will float with whatever the Fed decides rates are. So you're getting 5 now because rates are high. But if the Fed drops rates the next time they meet, you will not make 5. Okay. So second question. At the end of the year, Soto, do you get a 1099 for the interest that you earned on your traditional bank account? In other words, do you pay tax on that interest at the end of the year? Yep. Okay, there we go. Yep. And now that 5% is not guaranteed because it can go up or down. It is taxed. If you died tomorrow, would your family get any more money than what you have in the bank account? In other words, if you had 100 grand in the bank, Soto, and you died tomorrow, I'm not trying to kill you off or have you graduate, just saying, if you did, would your family get any more than 100,000? No, not at all. Okay, so that's just, every one of you already knew the answers. This is the traditional bank. So now let's try to find somewhere better to put our savings, not all your money, but your savings. That's all we're trying to do is something better. So if I wanted something better, I would want a guaranteed interest rate that never changes. So does that sound good? You want a guaranteed interest rate that never goes up or down. It's locked in. That would be good, right? So let's just say that guaranteed interest rate is 3.25. Now, I know you're getting 5 now, so even though you know the 5 can change, 3.25 just doesn't get you out of bed. You're like, I just don't know. It's still, I don't know. But what if I then said that this place will pay you dividends? So if the dividends are not guaranteed, I want to be clear, but they have never, ever not paid a dividend. In 140 plus years, they've never not paid a dividend. That'd make you feel good, right? That's a long freaking time. That's back to like the Great Depression times, I think. I'm not doing the math, but close, if not more. So they pay a dividend. So if we then take the guaranteed interest, which never changes, can never change, doesn't matter if the Fed drops rates to 0 like they did during the pandemic, it's always going to be 3.25. But with the dividend right now, and I can only give you today's numbers, I'm going to use the lowest, which is 575. So the dividend plus the interest is 575. Now, let me ask, Soto, is 575 more than 5? Would you be happier with 575 versus 5? Yes. But hold on, it gets better. So the 575 is what we're going to get, of which we know 3.25 of that never changes. Now, this 575 in this account is tax-free. You get no taxes. So really, your 5% in the bank that is taxed, depending on your tax rate, would have to earn more than 5 to get the same as a 5.75. Matter of fact, you'd have to probably earn like 6 to 6.25% in a taxed account to earn 5.75, the equivalent of 5.75 in a tax-free account. I forgot to ask you, Soto, over here, is the money that you have in the bank 100% private? So in other words, if you had to go to court and testify or you got sued, is that money private, or could they find that balance in your bank account pretty easy? Pretty easy, right? And is that money protected? Like if somebody trips and falls on your property, can they go after the money in your bank? Well, not only can they will. That's the lowest hanging fruit. So it's not private, it's not protected, it's taxed, and it's variable. Over here, you're getting 575, but that 575 is tax-free. It is private, 100% private. Matter of fact, no one will ever know how much money you have in this account. Not only that, it is protected in almost all states from judgments and liens. Not only that, you already answered this, but it's going to provide a legacy, a step up in the amount you have. So if you had 100K in this account, which I'll tell you what it is in a second, you probably already know, you're going to have a death benefit that far exceeds the 100,000. So let's just say 100 gets you a $500,000 death benefit that will pass on tax-free. Do you think your family, your spouse, your kids would prefer 500 or 100? Don't answer that. Yes. So we've already established that this place that I'm going to tell you to change where your money goes is significantly better than a traditional bank account by the pure facts, because these are all facts. You can look them up, you can research them, you can read the contracts. So where can you get this? Well, you all know what it is. It's been around for hundreds of years. It is called whole life insurance. Okay, so this is the vehicle we use because it does all of these things, whole life, fundamentals. But now I got to kind of upset the role here a little bit. We're going to use not a normal whole life. First off, we're only going to use a whole life from a giant mutually owned, State Farm is not mutually owned, Prudential is not mutually owned, just being clear, mutually owned life insurance company. And I want to be very clear about this. We are definitely not going to use an IUL, an index universal life, because it will not work for what I'm about to show you, because everything I just showed you, although it is tax-free, private, protected, and has a legacy, this rate is not guaranteed, okay? So we put this money in here. This is a specially designed whole life. So when I say specially designed, what do I mean? We're going to design a whole life from a giant mutually owned life insurance company that pays dividends. We're going to design it from a contractual level so that it does a couple things. Number one, gives you immediate access to your cash value. If you did a regular whole life from a life insurance company, you would have no money in year one, no money in year two. And I actually have all that here. We actually did a training last week showing that, where we showed like what a regular whole life would be. And indeed, there was no cash value in the first year and the second year. How many of you want to put your money, your safe money, your money that was in a bank, into an account that you have no money to use in the first year, no money to use in the second year, and hardly any money in the third year? Great. Well, then you don't want a regular whole life. You want your money now, right? So we're going to specially design it. And in order to do that, there's this weird thing that has to happen is somebody has to give so somebody else gets, okay? Who is the giver? Well, that would be us. Okay, when we design this contract, this policy for you, what we're going to do is we're going to design it so that it pays us less commission. All of you have heard that whole life insurance is high commission, pays big commissions. The only one making any money is those dumb agents. You want to talk about the only one making any money on is the dumb agents, you talk about IULs. So if we want to have that discussion, we could. But the whole life does pay a high commission, but it pays a high commission on the base. So what we're going to do is we're going to design and engineer this so that it has the lowest base in some cases, not all. And then the highest amount of your money, your deposit, is going to go into a rider called paid up additions, where we are paid significantly less. Let's say in the base, we're paid 55% here in New York. In the PUA, we're paid 2%. Do you want to get paid 55 or do you want to get paid 2%? You want to get paid 55. But in order for me to get paid 55, you have to take less money. So do you want to take less money so I get paid more commission, or do you want me to give up my commission so you have more money? Good, we're on the same page. It's a pretty simple equation. There's only so much money, and somebody's got to give and somebody's got to get. So that's how we do this. We design them so that we get paid between 60 and 90% less. And I'm going to show you some numbers in just a second. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. I always have somebody, and we got 200 and some people on here, so I got to come in. I want to show you something, because some people are still saying, oh, that's the dumbest place you could ever put money. So what I thought I would do is just show you this, okay, right here. Can everybody see this slide? This is old. This is as of 2021. Do you know who the #1 purchaser of whole life insurance is in the world? Does anyone know? It's banks, traditional banks. And here's the proof. This is from FDIC.gov. You guys can all do this. Matter of fact, actually, in a second, I'm just going to do a Google search and I'll show you. But FDIC.gov, go there. You can look up BOLI, bank-owned life insurance. All BOLI is a product that is created off of the baseline of a whole life insurance policy. Every single BOLI policy is a whole life in its core. Okay, they just call it BOLI because it's bank-owned. As of 2021, these are the amounts that these banks had. And these are only the top 5. Bank of America had 24+ billion. Okay, Wells Fargo had 19+ billion. JP Morgan Chase coming in at a meager 5+ billion, 6 billion over here at US Bank. And we use US Bank for PMC Wealth. And PNC Bank, not to be confused with PMC, is $8.7 billion. We're talking the B's, folks, not T's, but B's, 75 billion. If we were to count what this would be in today's numbers, 2025, it's over 100 billion. Okay, so banks aren't putting less money in BOLI, they're putting more money in BOLI because of the benefits that you're going to see. So now, if banks are putting money into whole life insurance, why are they not telling you to do the same thing that they're doing? I'll leave that question up to all of you. You can make a decision as to why that is or isn't, but it makes you wonder. And that is absolute fact. And Stephen, if anyone says they want me to do that Google search, I'm happy to do it, but I want to keep rolling. Fair enough? So here's how we're going to do this. We changed one thing. Soto changed where his deposits went first. He put them into a specially designed and engineered whole life. Now, we design every policy for that client's specific needs and goals. I don't know what Soto's needs and goals are at this point, but let's just say I did. We would design the contract around his needs and goals. So there is no one design that is the same. They can be similar, but they're not the same because everybody's needs and goals are different. Then what we're going to do is we're going to look at where are you leaking money? This is always the first place. And this is the fundamentals. This is Michael Jordan getting on the ball field or on the court, going back to basics. If a client has debt, the discussion has to start here. Because if a client has credit card, car loans, any kind of debt, lines of credit, if they're not being used, credit cards right now are over 20%. So let me just write 20, okay? Car loans right now are between 5 and 7, although I do still see some at 3. Home equity lines of credits are about 8% right now. So if you have this, I just want you to look at these numbers only. Credit cards, 20%. Car loan, let's do right in the middle, let's do 6%. And line of credit, 8%. You're making 5.75%. Do you want to make 5.75 or do you want to make 20? 20, right? Do you want to make 5.75 or do you want to make 6? 6, right? Do you want to make 5.75 or do you want to make 8? Every one of you would say resounding yes to I want to make more, because that's the thing. When somebody has money, they have a problem, and that is they want to make more money. The easiest way to make more money is find a way to make your money work at a higher interest rate. If in the bank or in this, especially designed whole life, because we've already eliminated the bank for the savings, we're making 5.75. Well, I want to make 20. I don't want to make 5.75. And people say this all the time to us. They will say, well, Chris, yeah, I love that whole life thing. And that's what they always say. I love that whole life thing. You mean the infinite banking concept that you learned? Yeah, that whole life thing. That's what they always say. Just so you all know, the whole life has nothing to do with the infinite banking concept outside of it's the safest and most efficient place to run your money through. The infinite banking concept is a process of taking back the banking function in your life, which is what we're going to do now. You see, this right here is you giving away the banking function. Credit cards are usually issued by banks. Car loans issued by banks. Lines of credit issued by banks. You are giving that away. They are taking control of that. You're not doing it. So infinite banking concept is you taking control of that back. We already took back control of our savings because we took it from the bank, put it in here. Now, if someone came to me and they said, all right, Chris, I'm going to make 5.75 or whatever that stupid whole life pays me, I'd be better off putting money in the S&P 500. Now, today, if somebody said that, I'd laugh in their face and be like, yeah, okay, you've been watching the markets, you've seen what's going on, you see that, like, if these tariffs go through, like we're in for a pretty interesting ride here. But anyway, let's just pretend everything's rosy and we're in this longest bull run in history. And they're saying, well, Chris, last year, my money in the S&P 500 made 23%. I'm not going to put any money in this stupid whole life to make 5.75 when I can put money in the S&P and make 20-some%. Is that a fair assumption? Anyone? Is that a fair assumption? Like, if you could make 20-some% in the S&P, why would you ever put money in something that makes 5.75? In doing that, you're making a comparison. You're making a judgment call to say 5.75 or 20. Risk, no risk, but still I'll take the risk. So you're saying, is it this, the whole life, or that? But what if it wasn't this or that? What if I said to that client with the S&P 500, I said, sir, you don't have to decide whether you're making 5.75 or 20. Why don't we make both? Why don't we do this and the S&P 500? Why don't we make money twice on the same dollar? To that, they would say, are you smoking crack? Or, they would say something around those lines. Like, is there something wrong with you? That sounds too good to be true. There's no way that's possible. But indeed, it is absolutely possible. But let's go away from the S&P 500 and just talk about debt. Somebody has a 20% interest rate on credit cards, and they've got money sitting in this whole life for 5.75. Now, let's put some numbers. You have $20,000 in credit cards. You have $40,000 in car loans, and actually, I got to do 25 because I have the math on that. 25,000 in car loans, and your home equity line of credit is 20%. or 20,000. So now let's put some numbers. 20,000 in credit cards. What does everybody think that would cost? Stephen, what do you think 20 grand in credit card, debt would cost at around 20%? What do you think they'd charge you minimum?
Ooh, great question. I don't even know.
Anyone want to take a stab at this? We got 220 people. 600 bucks? All right, let's do that. Let's use Craig. 600 bucks. So we got 600 on the table. Let me change my pen because I want you all to see this a little differently. All right, we got 600 for the credit cards. Now, $25,000 car loan at 6% is going to be roughly $500 a month. And $20,000 in lines of credit at 8%, let's call that, I don't know, let's call that another 600. So we got 12, 13, 14, 15, 16, $1,700 if I did the math really quick. So 700 or 1,700. Now, let me teach you all something. I want you all to take some things away. Grab your calculator or just follow along. I've got my little handy dandy iPhone calculator. I'm just going to figure out what is the average interest rate that I'm paying on these three debts. I take 20 plus the 6 plus the 8. Okay, that means the total is 34. So we got 34% is the total, but we got 3. So we're going to take that and we're going to divide it by 3. Okay, so divide by 3. I am paying an average of 11.33%. That's what you do. And this is how we always do it. It's just math. So 11.33% is the amount that we're paying. Okay. Is that more or less than 575? It's more. So here's what we would do. We would first, we got 100 grand in this account. We would take the money from the policy, but we're going to take it and we're going to treat that money just like we would treat the bank's money. We're going to take a loan. Now, I don't need you to understand this right now, but I just want you to follow along. These loan rates change by company. So I'm just going to put this varies. So I'm just going to use this for simple math. Let's just say it's 5%. Okay. So we can take a loan from the insurance company at 5%. Some of them, I think most of them right now are like 5.25 to, they go up to as much as 7, but 5%. So right there, if we're making 5.75 and we're paying 5, we are making a spread just like a bank. Okay. So I want to just preface that real quick, change some things here. I'm going to need some red. Now we took the loan from the life insurance company. They charge us 5%. We're going to take that loan. And what we're going to do is we're going to pay off the 20% credit cards. We're going to pay off the $25,000 car loans. We're going to pay off the $20,000 line of credit. Those debts are gone. I meet with people all the time that have this exact scenario. They have debts over here, but they have a bunch of money in the bank. They have debts over here with, just use this, 11.33%, but they have money in the bank. And people think that that is just the way to do it. I've been saving. I've got my emergency fund. I feel good about the money in the bank. I'm getting, we'll use Soto's 5% on the bank. But you got these debts. What you got to do is you got to expire the debts because this is where the money's at. But here's the process. Follow along. I took a loan for 5%. So they gave me, what would that be? 20, 40, 65,000. So we took a loan for 65,000. I'm just making this up as I go, folks. And we used that 65. We paid them all off. Now, remember, every month we were paying credit cards $600 a month, car loans $500 a month, line of credit $600 a month, $1,700 a month, and roughly 11.33% a year in interest. So what we're now going to do, this is vital. Go back to what I taught you earlier about that bank. And I was asking everybody, and then I even asked some people they probably should leave because nothing's going to help them, because this is where that is going to happen. If you were okay paying all these debts, and whether you're okay with it or not, you pay it reluctantly. You work overtime sometimes to make your bills, to pay your bills. You don't miss your bills unless things get really bad. So why, if you borrowed money from yourself, your bank, why would you not pay the exact amount you were paying to the credit cards back to yourself? I ask this question all the time. So what you're going to do is you're going to take this $1,700, whatever the amount is, okay? Your numbers are going to be different than these. We're going to take that 1,700, 600, 500, and 600, and we're going to set up a loan repayment. Nobody likes that, so let's just call it a recapture, because that's really what we're doing. We're going to set up a recapture, and with that recapture, we're going to recycle $1,700. That's the way you got to look at this. Nobody wants a repayment. Nobody wants a loan repayment, but that is effectively what we're doing. So let's just call it a recapture of the money that you were giving away, and we're going to recycle it back to where it came from. So we're recycling and recapturing the money we were giving away. What you are now doing is now you are making 11.33% because you are recapturing the interest rate you gave away. It is exactly the same thing. How much risk did you have to take doing that? Zero. You took zero risk because you were making these payments already. The only risk you have is if you're not an honest banker, which I already asked all those people if they could just leave because they're not going to get anything. So the $1,700 comes back into the policy. Now, let me ask 2 questions, and I want to get some answers up in the chat. Okay, I love this chat. Thank you all for playing along with this. It makes it so much more exciting. We've even got some people cycling while they're doing this. I love it. So if you were making, like, let's just use this. You made a $1,700 payment. It was a minimum payment on the line of credit and a minimum payment on the credit cards and just your regular payment on the car loan. If you needed some of that $1,700 back one month, could you get that money back? If you made your payments on your credit card, your car loan, and your line of credit, you paid $1,700 to them, but now you need some money. Can you call any of those banks and ask for $1,700 back? Okay, hold on. Kim said yes. So let me just quantify this. I want to make sure that they understand. When you pay a credit card's minimum payment, you're just paying the interest. We understand that, right? So if we made $600 in minimum payments to the credit card, you would have no money available on your credit card because you haven't paid back any principal. Your car loan, when you make a $500 payment on your car loan, can you go out to your car and extract $500 from your car? No. Can you call the bank and ask them for your car payment back? No. And the $20,000 line of credit, if you made a $600 minimum payment, which is just the 8% interest, you've paid no principal back. So indeed, in this scenario, $1,700 a month left your family forever. You can't get any of it back. Does that make sense? So Kim and just anybody else, maybe I just didn't explain it right. That makes sense, doesn't it? Okay, got it. Perfect. All right, so now let's change the role. You are the bank. You own the bank, just like we talked about earlier. But now you're going to do the same thing, and you're going to make $1,700 payments, but they're recycles and recaptures, all in how you think about it, back to the policy. Do you have $1,700 that you can use the next day? Remember, you couldn't with the other one, but now you paid back $1,700 to your policy. Do you have $1,700 to use the next day? Rich said yes. Craig said yes. Okay. Ginger said yes. Correct. Because you're the bank. Just like earlier when I said that, remember I said if you borrowed money from your bank, you would pay your bank back. You could pick the rate. It doesn't matter. Here, I didn't pick the rate. I just paid myself back the same amount I was paying them. Why reinvent the wheel? But listen, like, let's just say one of you had this exact scenario, but you were like, yeah, Chris, you know, that $1,700 was crushing my family. So although I would love to pay $1,700 back to my bank, but it's making it hard for me to live. If you owned the bank, could you come over here and you could be like, you know what? I can afford $1,000 a month. Would that change anything? No. When you own the bank, you make the rules. Thou with the gold makes the rules. It's your bank. So you could change this number to be anything you want. I was just showing you the simplest way of just repaying exactly how much you were giving away because, listen, that's the best way to do it. But now, even if you did do that and you were struggling, that $1,700 is available in the policy every month you put that money in. There's one thing that we got to attend to that I did not address, and I purposely left this out, which I think might have some of you a little bit confused. When we took the loan for the $65,000, whose money did we use? If we started with Soto, if Soto started with $100,000 and he was getting 5.75% on that $100,000, and he took $65,000 left, how much money's left in his bank? Now, this isn't fractional reserve banking, but if any of you took 100 minus the 65, and you said that's the amount, and let's see, did anyone say that? No, so you're all on this. Even Kim's got that. Kim was like, nope, you got 100 grand, right? So we got $100,000 in the account, earning 5.75, tax-free, private, protected, and you have a legacy, even though we got to use 65,000. Now, to some, they don't understand that. Fundamentals. We borrowed that money from the insurance company. The insurance companies have tons of money, billions and billions, probably hundreds of billions. I don't even know. Every company's a little different, of money sitting around. Literally, and every single month, people are putting money in. They're making premium deposits, so they have more and more money every month. So they just lend you this money out of their general account. And all they do, literally, they go in the computer and they say, okay, you had a $500,000 death benefit. We just borrowed $65,000. So what we're going to do is we are going to subtract $65,000 from your death benefit. That's it. So if you died the next day, if Soto graduated the next day, and he had this $65,000 loan out that he used to pay his credit cards off, the insurance company is not going to pay him the $500,000 death benefit that he initially got in the contract. They're going to pay him that minus the loan. Makes sense, right? And because insurance companies don't base their interest rate on their loans off of the prime rate, which is the Fed, they tie their interest rates to, and they're all a little different, but let's just call it the LIBOR bond index. So the bond rates. And if you understand how bond rates work versus prime rates from the Fed, bond rates change very little. They literally are they're like a turtle. If interest rates spike up, bond rates, well, they kind of creep up a little. If interest rates go down really fast, they kind of trickle down, okay? Bank, immediate reaction. If Soto was getting 5 and next month, let's just say Powell comes on and says, hey, we're dropping interest rates 0.5%, guess how much Soto's now getting? Probably 4 or 4.5 immediately. If the Fed drops rates 0.5%, how much is the loan interest rate going to be on the policy? The same. How much are they going to pay you? The same. You see what I'm saying? It's different when you're dealing with insurance companies, but that's how it works. So what we've now been able to do is we've been able to now take our 100 grand and make it work for us 24/7 while still having access to, not all of it, I'll show you that in a second, but most of it, having access to it at a lower interest rate in most cases than what we're making. I'll show you that too, to use that money. Now, you would never ever do this if you're just going to take loans out and spend that money. That's foolish because you're still paying 5% no matter how it is. In order for this to work, the rule of engagement is very simple. If the insurance company, we'll call this cost of money, is 7%, and I'm just using 7, how much should you make that money go to work for? Like how much to take a loan from that policy, your money would have to earn a higher interest rate than the 7%, right? So if it costs us 7% or 5's an easier number because that's closer to what we're at now. If it's 5%, we need that money to at least make 5.25%. I always go 1% more, okay? I use a 1% rule, so I'm a +1 guy, okay? That's how I operate. So if I was using this money for myself and I was going to lend money to one of my companies, guess what I'm charging? 6, because it cost me 5 and I'm going to charge my company 6 and I'm going to make a +1. You can decide what your rules are. You're the bank, you set your own rules. Okay, you don't have to report to the Fed. You don't have to report to the banking industry and the regulators. It's your bank. It's private. So you can do anything you want. And what you could do is you could say, this is my rate if I lend to myself. And if this, in the contract, if this goes up to 6, well, then this goes up to 7. Make it variable. But now let's say you did the same thing, but you lent money to somebody else. It cost you 5. What is your spread? Well, this is where you can have some fun. It isn't going to be +1. So how I would do that, if it cost me 5, my number's 12. You can call me greedy, it doesn't matter. So I'm making a 7% spread. Not bad. But for that spread, I'm taking on some risk. When I lent the money to myself, I'm really not taking any risk. But when I lend to somebody else, I'm taking on risk. Does that make sense? Simple rule. And then you just take the interest that you're making and you roll it right back. And now let's come back over here and I want to show you something really cool. And then I want to put some numbers to this. If this were the scenario, there's one thing I left out. It's very easy to hyper-focus on 5, 7, 5, and 5 because I told you to look at those two numbers. But that isn't really how it works at all because there's a cost of insurance and stuff like that. So it's not really a true 5, 7, 5 you're making. There's cost, like the cost for the death benefit, the cost for the commission, the cost for the policy service fee, which I'm going to show you all those numbers in just a second. And the 5% that we're making, okay, when we're doing this, the most important thing that I always tell people is don't focus on this as much as you normally would. Because in this scenario, if we did this, we want to make money twice on the same dollar. We are going to. But how we're going to do that is because every time this $1,700 goes back in your policy, because you recycled and recaptured it, yes, you have $1,700. But what we're also doing is we're reducing the loan. So we started with $65,000. Now, what does that work out? Let's just do 12 months. 1,700 times 12. Do this in just one sec. 17 times 12. So every year we are repaying $20,400. 1,700 times 12 is $20,400, okay? That's what we're repaying back to the policy. So every year, we increased our cash value by $20,400. But what we also did is we decreased the loan by the same exact amount, okay? $44,600 is the new amount that we owe to the insurance company. Let me tell you one other thing, but I want you to really understand what I'm saying. The insurance company is never going to ask you for this money back. They will never send you a letter. They will never call you. It would be kind of weird for you because you're so used to when you don't make a payment back to something or you don't pay a loan, they're calling you. The insurance company does not care if you ever pay the loan back because they already accounted for it by taking it away from your death benefit. To the insurance company, you not paying your loan back isn't such a bad thing because they're making money on you. But do we want the insurance company to make money or do we want to make more money? We want to make more. So what we do is by doing this, $44,000, let me just show you the math. We started out with a $65,000 loan. It's simple interest, so it's easy, times 5%. Your loan interest would be $3,250 year one, okay? And I'm just keeping this simple. Year two, 44,600 times 0.05 is only $2,230. $2,230 minus $3,250 means you just picked up an extra $1,020 because you bought the rate down. You didn't buy the rate down, you bought the balance down, which reduced your APR. Now, let me show you one other thing. Let's do some math. $1,020, okay, $1,020. How much would $65,000 have to earn to make $1,020? Well, let's divide that into 65,000. I think I'm doing this right. So about 1.6%. So 65,000 would have to earn about 1.6% to earn 1,020. So are we really paying 5%? Well, we are, but we're paying 5% on 44,600. So what's your APR? Really, it's 3.4%, give or take. And I might have done that wrong, but you bought the rate down. So I think that's probably correct. It's just the amount that you paid less the amount you were paying gives you the APR divided into it. That might have been too much math. Okay, now let's move on. I want to show you something because I want to show you some real numbers. Because some of you are probably thinking, hey, Chris, what does this actually look like? Like, I did a training last night and I could tell you the people just wanted to know what it actually looked like. So let me show you a real example. I'll show you two of them actually. And then I'm going to stop for a second. So this is a real policy. This guy's name was Kevin. He was a young guy. He's at a real estate conference that we were speaking at and came up after and he said, hey, Chris, I saw your presentation, loved it. I'm saving money every month because I want to buy a piece of real estate. I want to buy a property that I'm going to rent out. And I've got he had a little bit more, but let's just say I had 50,000 bucks saved in the bank. And he said to me, he said, Chris, could I take the 50 grand I have saved in the bank and could I put that money into the whole life? So here we go. 50 grand is called the dump in. He has this money in a bank account. And what he wants to do is change one thing, and that's where his money goes first. So the answer was yes. We can dump this 50 grand into the policy as a one-time deposit. And then he said to me, he says, I'm saving roughly $500 a month. Can I continue saving $500 a month into that policy instead of putting it in the bank? So I ran the numbers. Now, although he could not put 500 in because of the IRS rules, we got close. $491.25 a month is the amount he could put in, which is $58.95. So in the first year, he did this, okay? Put 50 in all up front and saved $491.25, $58.95. At the end of the year, he had $51,554 available. How much of his money did he have available? So to do that, we take 51,554, we divide it into the amount he put in, which was 55,895, 92.2%. So again, this is kind of where sometimes I have to know who my clients are and who my clients are not. So this is the downside. So stay with me. This is the worst part about doing your own bank. The worst part about using this specially designed whole life is, unfortunately, you have costs. There's a cost for the death benefit. In this policy, there's a cost for the commission. The commission is paid out. So on this policy, we wouldn't have made much, roughly, I don't know. I'll figure Stephen, can you try to figure the commission out? This, I believe, was a 75-25. Can you figure the commission out for me real quick so I can tell them? That'd be great. So they got the commission and the policy service fee, which was 50 bucks. So he only had access to 92.2%, or 51,000 of his 58 or 55.8. If that would be a problem for you in the first year, this won't work for you. I don't know many people that literally go to their traditional bank, make a deposit, and then come back at the end of the year and take all the money out of the bank just to say that they could. But I guess there probably are people out there. So if that's you, I just want you to know this would not be a good fit for you. Okay, fair enough. In the first year, this client, Kevin, if somebody does anyone on here need 50,000 bucks? Anyone need 50,000 bucks at 12%? Anyone in the chat? Anyone need 50 grand if it was 12%? Okay. Rosalina said 50 grand. So we got 50 grand is going to Rosalina, and Shane would take it as well. Okay. So we got 50,000 at 12%. So now if Kevin wanted to immediately take 50 grand out of this policy, he could. He takes 50 grand of the 51, he loans it out at 12, takes the 12, rolls it back in as a recycle and recapture. We just went over that. Now, does that change his return? Does his return change at all because he took a loan? Not at all. This is what's called a non-direct recognition, fundamentals. So when we do these policies, we build these with companies that are non-direct recognition. So now Kevin has 51,554 in the policy. We'll just say that it was making 5.75, although I think this policy was mass, so I think it was like 6.4, but let's just go low, okay? 5.75% is what he's making, okay? And he took 50 grand out, so he is still making 5.75 on the full 51,554. And he's also making 50,000, is making 12%. So he's making that. So I guess I should probably figure these numbers out. 50 grand times 0.12, 6 grand a year. So he's making 66K a year plus interest on all the amount. But he only had access to 91% or so, 91, 92%. Let's go to the second year. So the second year, Kevin continues doing what he's doing. He's loving this 6 grand a year that Rosalina's paying him or Shane's paying him. Doesn't matter who's paying him. He just wants somebody to pay him. And he puts the $491.25 a month in, which is $58.95. Now, I want to preface that this client is young. So this client was 38 years old when they started. So if you're 50-something, your numbers are going to be different, which I'll show you in just a second. But I just want to preface, this is on a young individual. So the numbers are going to look really good. But if you're older, 60s, your numbers are still going to look really good, but maybe not this good, okay? So he puts $58.95 in, and in that year, his policy grows by $7,141. That means in 1 year, this $5,895 was able to earn him $1,246. Why? Well, because he has $51,554 earning uninterrupted compounding interest. Has nothing to do with this 12%. The 12% isn't even factored in this return right here. This is just the cash on cash return. So let me explain cash on cash return if I can just for a second. So let me stop sharing. This is very important. I did a YouTube video on this, but I can do it super easy. Cash on cash return. There are 2 returns we use in this industry. There is cash on cash, and then there is cumulative. Most of you in your minds are going to want to go, because this is what you've been trained, you're going to want to think cumulative. But in our world, cash on cash is what matters. So cash on cash means, and I'm going to use Kevin's number. Kevin puts in $5,895. His cash on cash return was 21.41%. So what does cash on cash mean? Cash on cash means that year, this is his deposit. If he took $58.95 and put it into a bank account, that bank account would have to pay him 21.41% to equal what he earned in this policy, because $1,246 is his net increase. Net of commissions, net of cost of insurance, and net of the policy service fee. We can show it no other way, or compliance would be straight up our ass. So that's how much money he made. That's cash on cash. New dollars that you put in every year, this is the return they make, because that's cash on cash. Cumulative is a little different. So let's do cumulative here real quick. So cumulative, I can't use this one, but let me just explain it. Cumulative would be, let's just say somebody put 5 grand in for 10 years, okay? So they did this for year 1 through 10. They put in $50,000. A cumulative return would be looking at the total cash value. So let's say the cash value is $60,000. What is your cumulative return? How you would do this is you would take the $10,000 that it made, and you would divide the $10,000 into the total amount of premiums, which is 50. This person made 10 grand. Would that be 20%? Think that, yeah, you got to move the decimal, 20%, right? So let's just figure that out. I want to make sure I'm giving you the right math. I don't like being wrong when it comes to math. Yeah, that is correct. 10,000. So that's cumulative. So the cumulative return over a 10-year period in this would be 20%. But what we can do is we can take that 20% and we can divide that by 10 to figure out the average per year. So every year, cumulatively, if we averaged it, this person made 2% every single year on their money. How do you decide which one of these is the better return? Because obviously this sounded really sexy, but when you're down here and I break it down and say all you made is 2%, you're like, that's not so good. Well, here's how you decide which one works. It's very simple. If you're going to put money into a policy and you're just going to leave that money sit in the policy, all you're going to do is you're going to put money in the policy and you're just going to let it grow and you're just going to save it for a rainy day. In other words, you're going to do the exact same thing you do with your 401k, your IRAs. You're just going to put the money away for some use down the line in the future. Cumulative return would be an important metric. And as time goes by, years 11, 12, the cumulative return will grow and grow and grow because it's compounding. But we use cash on cash for infinite banking because every year, is our goal to leave the money in the policy? Is our goal to leave the money in the policy? The answer is absolutely not. Why in the world would you ever leave the money in the policy if the policy is still going to pay you the same interest and dividends if you took the money out, as we did with this example over here? You wouldn't. So cash on cash is the return we typically use because that's more relevant. We care only about the return we're getting on the new money because the old money's already out working. That 50 grand or 51 grand is out working with Rosalina. She's paying 12% on that. So that's going to be a separate return. We're making money twice on the same dollar. We're not making money once like you're used to. You're making money twice. Cumulative return is if you want to make money once. Okay? Cash on cash is what we use. And as we keep going, remember 5 years in, you put 58.95, now it's 26. So again, one of the ways to do this is if you made 21%, but you had to give the insurance company 5, do you care? No. If you made 115%, but you had to give the insurance company 5, do you care? Not much. Not much would be the answer. Some of you might, but I certainly wouldn't make that the most important thing. Now, I want to move on and I want to do one more thing, and then I'm going to open this up for questions because I know I've been talking a lot. I can feel it. I'm just trying to give you all tremendous amounts of value in terms of why. I focus a lot on the why. Why do you want to be the bank? Why do you want to be in control of your money? Why would I ever consider changing what I'm doing? Because what I'm doing feels like it's working. Well, now you know that by changing just one thing and adding one step, you can improve that process. I did it with debts on that example over here. Get back to it. But let's say we replace debts with investments. Let's say we replace debt with S&P 500, if that's your thing. Debt with private lending, okay? Debt with real estate. It doesn't matter what goes in this box. This box simply is your opportunity zone. This is where opportunity happens. And it doesn't matter what the return is. Follow the rule. If your cost of money is 5%, then figure out what your return must be. Is it 6? Is it 12? That's up to you. And then you decide how to use that money. Now, one final thing, since I want to show everybody, let's see, I got a 55-year-old, a 50-year-old. Let's do 55. Remember I said the numbers look a little different for a 55-year-old? See, we got a couple of great questions in the Q&A. You folks, your questions have been awesome. I haven't been able to pay attention to them, but I've been reading them as I'm kind of doing this. Awesome, awesome questions.
Yeah, they've been really good, man. Really good chatter in the chat.
Super good. That means all of you are either thinking, you're processing, you're asking intelligent questions. I love it. I love it. So here's another one. Now, what's the difference here? The only difference is the age, okay? This person's age is 55, very different than a 38-year-old. So what we're going to do is we're going to build a policy, and I'm using numbers here, 100 grand, and we're going to put the bare minimum, so 111. This is almost a 1-to-1 ratio, or 10-to-1 ratio if you figured it out. I don't want to get too technical, but that's pretty efficient. The most efficient way we could do this is if it was 110,500. When we design these, we know these ratios. We know how to build a policy that's incredibly efficient. And I'm going to show you what it looks like. This is actually a policy that we did for a client, but we're not able to use their name. So we call this client Speedy Gonzalez. 55 when they started, $100,000 dump in. They had 100 grand sitting in a bank account, and they wanted to put, they didn't save a lot of money, so they didn't want to put a lot of money each year. So folks, I'm giving you examples, but your numbers will be your numbers. We will not work with anyone and tell you how much money you're going to put into your policy. You will tell us what you want to do. Well, Chris, we were thinking we wanted to put 20 grand in up front, that dump in thing. What's the minimum amount we can put into the policy? Okay, well, the minimum amount would be 10 to 1, so let's call it $2,500, give or take. Okay, or actually, no, about 4 grand. Okay, so it's just figuring it out like that. But you might say to us, hey, Chris, we want to put 25 grand in as a one-time dump, but we want to put the most amount we can. Okay, so great. Well, let's put 10 grand or 12 grand or 15 grand in per year. Whatever you want your numbers to be, they can. The minimum, just so you all know, just take your age and add a 0 behind it. That's your minimum monthly amount you'd have to put in. That's all you need to know. Back to this, 100,000 plus 11,000. So we got 111 that went in. You can remember, we're going to lose money in the first year. Okay, we're going to lose money. We lost $9,172, which means we only had access to 91.74% of our money. Again, for some people, this just doesn't work, because for some people, they're just like, I can't do that. I don't want 91%. I want 100%. Well, you can't have 100% when the insurance company is giving you a $1.348 $131 death benefit. See, you can know these are custom designed because have you ever seen a life insurance policy that had a death benefit that made no sense like that? It's because the death benefit isn't the relevant thing. We're using the death benefit to satisfy the IRS rules. And this is what the IRS tells us you need in death benefit to be able to put $111,000 in at a 55-year-old age. Okay, fair enough. But again, this person has 101,000 of their 111 to use. Plus, if they died, they have a $1.3 million death benefit to which they lost access to 9,172. But now they take that money out and they lend that out to Shane at 12%. And what Shane would do is go buy cars. He would put them in his Turo fleet and he would rent them out and make way freaking more. We've got a case study coming into my YouTube channel with his, so please stay tuned for that. But here we go. Let's go to the second year. Second year, we put 11,000 in just like we did. How much can we take out? 11,729. So now we made 6.63%, not 21, but 6.63. If this policy had a loan interest rate of 5.25 and you were making 6.63, you can figure out that magic spread that is so important to banks. It's the difference between the two. The next year, this person puts 11 grand in, and let's just assume they take that out again and they lend that out to Shane again. Okay. Next year, they put the same amount in, but now they got 12.2%, $12,000. They put 11 in, take 12,000 out. Now, people ask us all the time. I'm going to go a little over. Is that okay? People ask us all the time, when can I stop making premium deposits?
Hey,
Okay.
Chris.
Yes.
Sorry, real fast, before we get there, we got a really special offer, and I know we're at the hour, so people are going to start having to move on. So I just wanted to make sure we get to that real quick. Is that all right?
Yeah, it is.
All right, cool. So as you guys know, we were talking about March Money Madness and doing this as a 4-week series. So the recordings of this are actually going to be limited to MSTV members only. Is that right, Chris?
That is true.
Okay, cool. So what we're doing is if you want to watch this replay, you want to be able to go back and see it again, anything like that, we're going to put it into our members only area. So this is kind of new for us. We launched Money School TV back when COVID hit at the beginning of 2020. It was our way to start kind of giving back. You know, we could have, our mentors, people advised us, we charged a couple $100 a month for this membership, but it was actually your wife, right, Chris, that decided.
Yeah, my wife. She said, people can't afford that. You got to make it affordable for everybody. Think Netflix. And she said, $19 a month is the most you can charge.
Yeah, so $19 a month. And even with inflation and everything over the last 5 years, we had a meeting back in November and we decided, hey, let's leave this at $19 a month. So we decided to even make it better. If you want to join us for an annual subscription, you actually get 2 months free. So it's $190. You get access to all of it for an entire year. So kind of go down through there. So you get the annual subscription. So when you log in, there's going to be all kinds of videos on all kinds of different financial strategies, a lot of mindset, different interviews that we've done that are exclusive only for MSTV. You also get access to the Legacy Builder course, the What Would the Rockefellers Do book, Mapping Out the Millionaire Mystery book, Private Money Guide book, the Ultimate Car Buying Guide, as well as all the recordings for this Money Madness trainings. We also do a live show every single Thursday at 11 a.m. That's exclusive only for Money School TV members. And we're going to be adding to those live shows as well. So we're going to get to 3 shows a week here in a couple months, and then we'll make it 5 days a week. So you're going to continue to get more and more value and education from this membership. So $197, you get all of this stuff for the next year, and we'd love to have you part of the community. So if you're serious about making a change in your financial situation and really starting to develop as a person, this is a great, strong place to start, Chris.
Awesome. Yeah, and we spent a bunch of time thinking about this, figuring out what we could give everybody for the March Money Madness. So this is what we came up with, and it is a tremendous offer. I mean, you would spend $197 just to get MSTV. Okay, it'd be actually more than that. But now what we're giving you, this Legacy Builder course, which is essentially the Rockefeller family banking system. It's a bunch of trainings. It's a bunch of it's a booklet that you can kind of go through that walks you through it. That's been super popular. And I think the value is more than $97. All the books, we're giving you What Would the Rockefellers Do book. We bought the rights to that book to use it. So we licensed that. We got my book with Brent. We got my original book. We got my car book showing you how to get all the money back for every car, plus all the recordings for all 4 weeks of March Money Madness. But they will be edited and they will be very easy to track through. So all of that, if you added it up, would be $748. Today, $197. And it's not just today, it's all of March. This is the March Money Madness offer. Awesome. So we'll keep putting that in the chat. Grab that. And that's the only way you'll get the recordings. Does everybody like this stuff? Does it can you feel the passion? Like, I can't shut up because I get so excited, and I have such a hard time when people don't people sometimes are just like, I don't get it. This doesn't make any sense. I'm just like, it's just math. I don't understand what they don't understand, but hey, not for everybody. And the other thing too, remember we talked cumulative. This is important because the biggest thing I get on social media, and I wanna show you something. So please just take a second and pay attention before you hop off, because this will really be an important thing. All the time, we hear people say, oh, that stupid whole life stuff, that infinite banking thing, you should just buy term, invest the difference. We literally did an entire white paper. You know what, Shauna and Stephen, we should include the white paper into the bundle. We did an entire white paper on buy term, invest the difference. It was accepted by the industry, so we sent it out to all the industry experts, and they've all read it. We had an economist read it. Although they can't endorse it, they loved it. It's the most comprehensive buy term, invest the difference summary and mathematic comparison. And we compared dollar for dollar, apple for apple, asset for asset. Buy term, invest the difference with, do this specially designed whole life. We didn't even use the really optimum whole life policies. We used the 60-40, which is Nelson Nash. Put money into the whole life and use it to invest in the exact same thing you would with the buy term, invest the difference. We literally crushed it. Craig Yenny put, I don't know, weeks of time into this. And we made lots of revisions because people would come back and be like, I think you should change this or show this, or what about that? It is very comprehensive. So we did that. But here's the sum up of it. Buy term, invest the difference will fail most people. And not only that, buy term, invest the difference by the pure mathematics is not better over a period of time than what I'm showing you here. But here's the thing. Let's just get down to the brass tacks. Why do people buy term insurance? Because it's cheap, right? Because their premiums are cheap. But are they really cheap? Actually, your premiums in a term policy, although low premiums, they're cheap, are the most expensive premiums you'll ever pay, because you have less than a 2% chance that death benefit's ever going to pay out. Less than 2%. It is a cash hog for the insurance companies. But let's just say you looked at a whole life policy. Let's just use this one. The break even, the cumulative break even takes you 5 years. Okay, so here you go. 5 years. So we put money into this thing for a period of 5 years. And in the 6th year, we have broke even. We have made money. Okay. So now every year from that point forward, we will make money, and it will cost us. I can't say it will cost you nothing because you're still putting premium deposits in, but you are making money on every dollar cumulatively. This is not putting money in, taking it out, and making it go to work. This is just cumulative. Put money in, leave it sit there. So let's just look at it this way right here. Okay. We put this money into the policy and we now made $1,266 on that. So how much did this $1.4 million death benefit cost you really? Well, you made $1,266. So what did it cost you? I don't know. You made $1,266. But even let's go up here, $2,326. Let's just cumulatively add all this up. I want to show this to you. Let's actually come down here. So this year, here, I did this before. Give me a second. I'm going to do this because I think you'll all like this. And I'm just going to summarize the numbers here. I'm adding up the negatives first. I got another, we did a YouTube video on this, so I'm pretty familiar with how to do this. 5,096 plus 2,000, what is that? 36, 26. My math might be a bit off. So over the course of this 5 years, this policy has literally cost you $32,198. That is your pure cost over 5 years. So 5 years, I added up all of these. That's what it cost you, okay? Now let's divide that by 5. That means each year your cost, your net cost was, that's a terrible 6, $6,439. That's your net cost, okay? There we go. That's your net cost. But hold on, how long does it take to turn positive where it costs you nothing? Well, now what we got to do is we just come down here and we start adding these up. Do it with me. 1,266, 5,727. What do we got? Already in 2 years, right here. So by the 7th year, we have made money. So by the 7th year, we have made $6,993. It cost us $6,439, and then we made $6,993. So literally right here, from this point forward, every year in this policy, this is money in the bank. Your death benefit will always be there and will continue to climb as you're seeing, but that's pure gain. What's more expensive, term or this whole life? You can all see the math. In the early years, $6,439. I bet you a 55-year-old going to the cheapest life insurance company that sells term, buys a term insurance policy, I would almost guarantee you a term policy for $1.348 million on a 55-year-old is going to cost more than this. Even if it doesn't, it's definitely going to cost more as you go down time. So I just wanted to show that because the thesis for what we were talking about when I mentioned that other example with the buy term white paper, which we'll give you. So Terry says you don't understand. I basically what I was trying to show you, Terry, is I was trying to show you term insurance versus a whole life. Which one costs more? And over in a 7-year time frame, the term insurance would cost you way more money every year after the 7th year. The term insurance would be cheaper in 7 years, but maybe not. Actually, probably not. Close. The whole life would be the cheapest thing because you'd actually make money on it. Does that kind of make sense? I probably didn't need to go there today, but I still wanted to show that. All right, Stephen, I'm going to pause and let's just go into, is there any questions that we did not address? We still have 183 people on here, and we're going to be back again next week. Next week, we're going to be talking about, here, I'll give you what we're talking about next week. So next week, we're going to be going into self-directed IRA. So we're going to talk about your retirement money. And we're also going to be talking about your house, not just your house, the hidden equity, the money that is sitting in the walls of your house. We're going to be wrapping all that into this. So I'm going to stop talking and let Stephen kind of bring some things. We got some good questions.
I've been trying to hit all the questions as they're coming in over there, but if anybody has any that I haven't got to or wants clarification, definitely put them in.
I got Lisa. Can I hit Lisa's real quick?
Yeah, go ahead.
So Lisa said, why is the annual premium going down at year 8? So she's referring to the annual premium in this. Why is it going down in year 8? So I want to show that to you. It's very easy to see. So year 8, right here, your premium went down to $9,205. What happened in year 8 is, shoot, I got to get rid of this. Where's my little thingamajigger? When I have this many screens, I forget where things are. Anyway, I can't really, there we go. Right here, this was a term rider. So to make this policy work, we used the term rider to get this death benefit. So in that 8th year, when the premium drops from 11 to 92, what that is pure cost of a $1,057,000 7-year term rider. So if you did a 20-year term rider, it would be way more. We only use a 7-year term rider because we only need the term on the policy for 7 years. So in the 8th year, this drop is because we got rid of the term insurance, but hence you can see the death benefit fell as well. But the death benefit goes up as the cash value goes up because of paid up additions. And there you go. Here's the bare minimum. Here's the other thing I forgot to mention. Every policy we do, you're going to have the premium deposit you want to put in, and there's also going to be a minimum. Here's your minimum. So you have flexibility from $11,000 to $5,500. So if something got tight, you couldn't do $11,000 one year, you can drop down to $11,500, but you'd always want to add $100, $120 actually. So it'd actually be the minimum, $56.20, and then you could drop, and then you could go back up and make up that $11,000 that you did not put in, or whatever the difference is. So that's your threshold. You can go here to here, there to there. Good question.
All right. I got two more questions for you. First one from Sam. When planning these policies out for long-term growth, is Steven as much of a badass in person as he seems to be on screen?
Absolutely.
You can tell me. All right, serious question though. Lynette said, infinite banking, consider providing a webinar for retired people living on fixed income who have money to invest, but not necessarily the years. Their scenario, age 66, no debt but mortgage and HELOC for home improvement. If they don't need to buy a new car, but pay off the HELOC, and hopefully the mortgages stay out of debt, enough income to stay on top of inflation, hope to even enjoy life a little, take vacations, etc. Not sure how many people in your audience that you have this predicament. And then Michael, kind of the same, you know, what if we don't have big money to put into the whole life and we're 70 and 72 years old? So maybe some strategies like that.
Yeah, I think the other days for March Money Madness are going to really go into things that you're going to be interested in. But for Lynette, one of the things I think that would start with is not a webinar. What that would be is more of a case study. So we'd need to get you on a call. We'll put, Stephen, I don't know if you've been sharing the link to book a call, but we'll put that in here. Book a call with one of our team members. Let's figure out your situation, because I know you gave us a lot of info there, but it's on a webinar. I'd like to really figure that out. Then what we would do is we'd come up with a solution for your problem. We could then case study that. And just like this illustration, Speedy Gonzalez, we just remove your name when we make somebody else's name, but then we can do a webinar showing your actual situation, just not using your name, unless you wanted us to use your name. Shane did a case study on his scenario that's going to be coming out on YouTube shortly. So love doing those, and we do a lot of them.
Cool.
So I know that was a lot of info. I covered more than just the basics, but I covered the fundamentals. And as long as what you got out of today was not the numbers, because the numbers, sometimes people's eyes glaze over. I didn't want to go so deep into the numbers. Really what I wanted to focus on is, does this make sense compared to what you're doing now? Red pill or blue pill, right? You got to decide. Do you want to stay plugged into the existing system, or do you want to take back control and create your own banking system? Because banking is the ultimate. And Nelson Nash always said there's two businesses that everyone should be in. Number one, the business or the job that pays your bills. Number two, everyone should be in the business of banking. What we just showed you is how to be your own banker, how to become your own bank and take back control of your money. So I hope you enjoyed the first ever March Money Madness episode. This will be recorded, edited, and put up on MSTV. If any of you are interested in MSTV, again, I'll put the link there. Grab that MSTV bundle to get the recordings and a whole bunch of other stuff. It's only $197. And then after the year, because that gets you one full year, after that, it's $19 a month or $190 a year. So with that, thanks everybody for joining us. We really enjoyed your questions. Some of the best questions I've ever seen on one of these webinars. Stephen, thanks for diligently trying to keep up with those. I don't know how you did it, but good job.
That was awesome. That was good.
All right, folks. We'll see you this afternoon for Ask Me Anything Happy Hour, and we'll see everybody back next week, 1 p.m. Eastern, for the next episode of March Money Madness. Till then, have a good day. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.